Hey class, we'll be starting our accounting unit.
Boring. Can we learn about something else, fam?
Are you kidding me? What's boring about accounting?
Everything. There's nothing interesting about it.
Well, hopefully by the end of the lesson, you'll change the way you think of accounting.
I'm probably not gonna.
Okay then, the first lesson we'll be learning today is assets, liabilities, and owner's equity. Assets are resources owned by a company or person that can be expressed in a dollar value such as cash, accounts receivable, and land, and etc. While liabilities are the obligations of a company or money owed to others, like accounts payable, bank loan, or mortgages. And finally, there's owner's equity, the net worth of a business, and is found in the most important equation in all of accounting. Assets minus liabilities is equal to owner's equity, or can also be used to find assets by changing the formula into owner's equity minus liability equals to assets. Now, wasn't that exciting?
Eh, not really. It was actually pretty boring.
Well, hopefully tomorrow's lesson will change your mind. It's a new day. You know what that means. A new lesson.
I'd rather not do anything today.
Too bad. We'll be learning a new lesson.
Uh-uh.
For today's lesson, I'm going to teach you all about the debit and credit theory and how transactions are recorded from it. Before I tell you about debits and credits, you first need to know about the T accounts. The T account is a simple type of account used to explain accounting theory. A T account has two sides to it, the left side and the right side. In accounting, the left side is called the debit side and the right side is called the credit side. Debits and credits are words used to increase and decrease the values of accounts according to the rules of debit and credit. All assets accounts usually have a debit balance, while liabilities and owner's equity normally have credit balances. There are rules for debit and credit. Assets increase through debit and decreases through credit, while liabilities and owner's equity increase by credit and decrease through debit. There's also a rule that for every debit there must be a credit or vice versa. For example, if you were to buy a car, then the debit side would increase since the car is an asset. But that would also mean that cash would decrease and would be affected. But if you were to buy a car on a loan, then that would now become a liability and the credit would increase.
What? What happened? I fell asleep.
With your eyes open, sigh. Maybe tomorrow's lesson will change your mind. We'll be learning about the expanded ledger. Both the asset and liability sections each have several accounts. Now, owner's equity has its own accounts. These new accounts include revenue, meaning the sales of the goods or services. It has a normal credit balance. Expenses, meaning the costs related to the revenue. It has a normal debit balance. And drawings, meaning the owner's withdrawal for personal use. It has a normal debit balance. From the revenue and expenses, a company can tell if they earned a net income or a net loss. The expanded ledger's main purpose is to provide information about the progress of the business.
Wow, sir. That was really interesting. Accounting is actually pretty amazing.
See, I told you so.
Maybe one day I can become an accountant.
You're a failure in life.
Debit on the left.